All right, let's talk about Tesla. It's one of those stocks that's always in the headlines, but right now, something is different. The charts are practically screaming that a period of quiet is about to end and a big move is coming. So in this breakdown, we're going to dig into the charts, the numbers, and the really big picture vision to figure out where Tesla could be heading next.
So, the big question on everyone's mind, is Tesla about to make a big move? And the short answer is, you bet. The stock is coiled up at a supercritical point, and all the technical signs are flashing, pointing to a huge spike in volatility. The only question left is, which way is it going to break, up or down?
And to see why, you just have to look at the charts. On the left, you've got the weekly view, which kind of looks meh, it's neutral. You see that big run-up, and now it's just been taking a breather. But then you look over at the daily chart on the right, and that's telling a totally different, more bullish story. Things like money flow and relative strength, they're starting to wake up. And it's this conflict, this tension between the long-term and the short-term view that's really getting interesting.
Okay, so that brings us to our first section, Tesla's ticking clock. Because, let's be real, this tension that we're seeing in the charts, it's not going to last forever. There's a major event just around the corner that's going to force its hand.
And you know, all this pressure that's building up in the stock chart is pointing to one single day, October 22nd. Yep, that's Q3 earnings. This is the catalyst. It's the event that everyone is waiting for to break this deadlock and really force the stock to pick a direction and go.
So before that report actually drops and potentially shakes everything up, let's zoom in and really understand what the charts are telling us right now. Welcome to Section 2, Decoding the Charts.
Now, the most important pattern happening right now is something called a Bollinger Band squeeze. And look, don't let the name intimidate you. All it means is that the stock's trading range is getting tighter and tighter and tighter. It's like the stock is holding its breath. And these periods of low energy almost always come right before a huge energetic move. Traders call it a volatility expansion.
And wow, this image just says it all, doesn't it? You can literally see those gray bands on the outside pinching inward on the price. That squeeze is building up potential energy, just like a coiled spring. It's wound up tight, just waiting for a catalyst, and in this case, it's earnings to release all that energy. But here's the really fascinating part, what's happening just beneath the surface. While the price looks all quiet and sleepy, the internal engine is revving up. Key metrics, things like relative strength, money flow, and volume flow, have all flipped from neutral to green, or N to G, at the same time. This kind of synchronized shift is a classic sign of what's called reaccumulation. It basically suggests that the big players, the institutional investors, might be quietly buying up shares, betting on a good outcome. Okay, so let's talk real numbers. What are the key levels you need to be watching? Well, the immediate battle lines are drawn. You've got resistance, the ceiling, up around 446 to 452. And you've got support, the floor, right around 420. If we get a solid close above that resistance, that's a huge bullish signal. But the real line in the sand, the absolute must-hold level for the bulls, is that primary support zone down there between 400 and 405. Now let's connect what we're seeing on the charts to the actual story behind the company. That brings us right into Section 3, the earnings showdown.
The entire story for this earnings report really boils down to this one simple conflict. It's a classic tug of war. In one corner, you've got absolutely fantastic news, record-breaking vehicle deliveries. But in the other corner, you have the big worry, a margin crunch. It means they're making less profit on every single car they sell, and that's the battle Wall Street is going to be watching.
So first, let's talk about the good news, the bull case. Almost 500,000 vehicles delivered in just 3 months. I mean, just think about that. That number is staggering. It blew past what analysts were expecting and proves that the company's growth story is absolutely still on fire. But here's the other side of the coin, the bear case. Analysts are expecting gross margins to fall somewhere into the 16 to 17% range. Now, that's a pretty big drop from where they used to be, and it raises some serious questions about their long-term profitability, especially with all the price cuts they've been doing.
So you've got this clear conflict, right? Growth versus profitability. So where do the experts land? Well, if you look at the consensus from 53 different analysts, the overall rating is a firm neutral or hold. They're basically just sitting on the fence, throwing their hands up and waiting for the earnings report to give them some clarity.
But that boring neutral rating is hiding an absolutely wild story. Because if you actually dig into what those individual analysts are predicting, you see just how split Wall Street really is. The one-year price targets range from a low of $120 all the way up to $600.
I mean, that gap is massive, and it tells you everything you need to know about the deep, deep uncertainty around this company's future.
All this uncertainty, it kind of forces us to just zoom out, pull back from all the short-term noise, and look at the much bigger picture. And that brings us to our final section, Tesla's real mission.
This right here, this single quote just reframes the entire conversation. The idea is that we need to stop thinking about Tesla as just a car company. At its heart, it's really about solving artificial intelligence in the real world, from cars that drive themselves to humanoid robots.
And this mission, it really has two parts, described here as atoms and bits. Tesla is the atoms company. It's tackling AI in the physical world of cars, batteries, and robots. Then you have its sister company, xAI, which is the bits company. It's going after generalized digital intelligence. And the argument is that these aren't separate things. They're two sides of the very same coin.
And this slide just brilliantly lays out why a deep link between these two companies feels, well, inevitable. It really comes down to three key things. First off, data. Tesla's fleet provides a fire hose of real-world video that's just the ultimate training ground for an AI. Second, you've got compute power. Combining their massive computer clusters is just way more efficient. And finally, the last piece of the puzzle, embodiment. A powerful digital mind, like what xAI is building, needs a physical body, like the Optimus robot, to actually interact with and learn from our world. You can't have one without the other.
And that leaves us with a final, and I think a much more important question. Is the real long-term story here about a simple financial merger between two stocks? Or is it about something much bigger, a deep technological integration that's trying to build a future of artificial intelligence? That's the question to chew on, and it goes way beyond any single earnings report.